Good morning, ladies and gentlemen. Welcome to the People Processes Podcast. Let me tell you what happens when a 20-person company in Ohio hires their first employee in Pennsylvania. The owner thinks they just hired a great remote worker, and maybe they did. But what they also did, without knowing it, is create a tax nexus in Pennsylvania. That means they now owe Pennsylvania income tax withholding. They need to register for Pennsylvania unemployment insurance. They might almost definitely need to update their workers' comp to cover Pennsylvania, and they're subject to Pennsylvania's employment laws, leave laws, paid sick, anti-discrimination statutes, the whole stack. But here's the part that really catches people off guard. The one employee may also mean that their company now has to collect and remit Pennsylvania sales tax if they sell to customers there. And they may need to file a Pennsylvania corporate income tax return even though they don't have an office in that state. One hire, 7 or 8 new obligations. And most small business owners don't find out about this until the state sends them a penalty notice or an audit. So today I want to walk you through exactly what gets triggered when you hire in a new state and the 6-step checklist that keeps you legal. So let's kind of go through the problem and why this catches people. When you hire an employee in another state, it feels very simple. It's not, but it feels that way. When an employer picks someone up in another state, they think, I hired a remote worker. They're working from home. I'll just add them to payroll with a different address. Most payroll systems handle withholding automatically, so it seems. And the employer, assumes that compliance is part of that, but it's not. What often happens is you're entering an employee's home address. In another section of your payroll system, you have to set up your work locations. Someone can work in Pennsylvania, drive a long way to Ohio every day, and go to work. As long as they're working in Ohio, whether they're a resident of Pennsylvania or not, you don't have to worry. It's all Ohio. But if they work from home, then congratulations. Technically, you've opened an office in Pennsylvania. Just like if you went and leased some space and got them an office, it's the same as if they're working from home. So while the withholding tax that would apply there, if they drove all the way to Ohio is Ohio, if they work from home, it's Pennsylvania. And your system is likely not going to catch that unless it has a flag in there to say this work location is now this employee's house. Okay? You just created a physical nexus in a new state. A single remote employee, if they work from home, if they work from there, is a legal anchor tying your company to that state's entire regulatory system. Just like when you opened your business at the beginning or your organization, the state you opened in, you just opened in a new state. It's just like opening a branch office without any of the planning or infrastructure that comes with actually opening one. Hiring someone remote does the same thing. Nobody opens a branch office without talking to me first about the tax and legal requirements, but they hire remote employees in new states every day without checking anything, and it drives me crazy, and it's going to get them in a lot of trouble. So, you have this employee working from home in Pennsylvania. You now have to withhold Pennsylvania state income tax. You have to have Pennsylvania unemployment insurance. Your workers' comp out of Ohio does not cover workers in Pennsylvania. Every state has its own workers' compensation regulatory scheme. You have to talk to your insurance broker to get that workers' compensation to cover them over there at home. The state employment laws, leave, sick leave, disability, wage and hour, mini COBRA, mini FMLA, all that stuff are different in every state. There are different posters, notice requirements, so the labor law posters and all those kind of things. In Pennsylvania, there's locals, local city, county ordinances, all kinds of things. You may have incurred a sales tax nexus, and you may require that you file corporate income tax filings. Even if you don't sell to anybody in Pennsylvania, you may have to file a zero return. Okay? 8 obligations from one hire. So most employers get 1 or 2 of them, income tax and maybe workers' comp, but oftentimes, one of the first things I clean up when I'm brought into a group is that their workers' comp doesn't cover their remote workers, which is illegal. The problem here is manyfold. Obviously, those of you in the business can go, oh my gosh, that's a lot of problems. But if you withhold taxes from the wrong state, you get penalized by both of the states. The state you paid says, well, we'll keep this. You still owe the right state. The state you should have paid says you owe us back taxes plus interest and penalties. It's a bit of a booger. You have to file amended returns in the new state, in the incorrect state to get the money back, and then file amended returns in the correct state, late normally, pay penalties and interest in those. A company headquartered in New York that hires someone in North Carolina and withholds a New York tax, that employee gets the wrong W-2. The company owes North Carolina everything it should have withheld, plus penalties, going back to day one. If it's been more than a calendar year, the employee likely already filed with New York and got a refund because they don't work there. They work in Carolina. So New York doesn't have the money either. And because you did it wrong, you owe it. Okay. So the math that goes wrong when you miss this is large. Workers' comp, for example, New York charges $1,000 per day for operating without coverage. We've had clients that walk to us with an $89,000 bill because they hired someone in New York and didn't get workers' comp. New York workers' comp is a really weird set of workers' comp. You have to be very specific about it. So and they check it. You'll get a letter quick. California, up to $10,000, fine. Plus, it's a misdemeanor. Most states require workers' comp for even one employee. If you don't have it in the right state, the fines are per day, not per incident a lot of times, and they can stack up fast. Wrong state withholding, right? If you withhold for the wrong state for 3 years, that's easily $10,000 to $50,000 in back taxes, interest, and penalties. Plus, you're going to have like late filing minimum penalties, those sorts of things. And that's for just one employee. Scale that to 5 or 6 or 10 employees, and you're looking at 6 figures. Sales tax is another place I see people get in trouble with. If you fail to withhold sales tax, if you fail to collect it, you owe the tax plus 25 to 35% in penalties in most states for it being late. The sales tax one is a huge sleeper, and I've seen it take businesses out. You hire one person in California, and suddenly you're on the hook for California sales tax on every sale you make to a California customer. Going back potentially years because you haven't caught this. Now, I've seen people get caught on the employment side, but the sales tax one is one that when the audit comes, it is just incredibly painful. Okay. Or you can get it all right. Register in the fees register in the state when you hire somebody. Spend a couple hours setting it up. It's so easy. The math does itself. It's definitely worth getting this right. Don't try to fly under the radar with work from home employees in other states. Okay. Do this before you hire the employee over there. This is going to be kind of a 6-step process, or as soon as possible, and it's going to really help you out. So this is what we walk through when we hire in a new state. First, we register with the state. Before the employee's first day, you need state income tax, state unemployment tax, and workers' compensation. Those are the top 3 immediate problems. Normally it's the state Department of Revenue, Department of Labor, and your broker to talk to in those orders. Managing HR in-house is overwhelming. That's why we built the People Processes Advisory System. Start with our free HR resource library, get instant access to policies, guides, and compliance checklists. The templates are just the beginning. Run our Strategic HR Audit to scan all your key domains for your people processes. In just a few hours, we'll work through and identify your compliance gaps, and my team will generate a custom roadmap for you, meet with you, and show you exactly what to fix step by step, ready to execute. Use our toolkit to generate job profiles, deploy policies, track employee documents. You're not alone. You're backed by a 5-star expert team supporting over 10,000 employees nationwide. Be your team's secret weapon. Visit advisor.peopleprocesses.com to start your free account today. Some states have a combined form where you fill out one and you get withholding and unemployment. Some you have to do 2 different ones, and you're going to get a state withholding number for your unemployment and for your income tax withholding. Most of this can be done online in an afternoon. It takes a little bit for them to issue, could take them a week or 2, but the forms are relatively straightforward. It's often the Secretary of State or the Department of Revenue for the income tax withholding, and then the Department of Labor or Workforce Commission, as it's sometimes called, for the unemployment. And then the state tax, like I said, the workers' comp, you gotta go talk to your insurance broker, because some policies cover multiple states, but most don't. You have to do them individually, and every state's different. They may cover 30 states, but not all of them. Then you got to set up your tax withholding. Withhold based on where the work is performed, boots on the ground, not where you're headquartered. There are some kind of unusual exceptions to that called reciprocity agreements that exist between the home state and the employee's state. This would only apply, okay, if the employee's home state is not where they work, okay? But in most of the work from home that we're talking about, they're always going to be, it's just going to be a whole new state, okay? But if you happen to have people, it's worth checking while you're looking at this, who, for example, work in Ohio or live in Ohio and work in Kansas, some of those kind of closer states, you can have reciprocity agreements that can change this up. But 99% of the time, it's where they're working. Okay. And if they're working and live in the same state, because they work from home, then you owe income tax in that state. You got to set that up. Then you got to look at the state's employment laws. If you go back to episode 71, we have a whole thing for leave obligations. We can help you look those up. You got to look at paid family medical leave. Does the state have a program? Is there a mandatory employer payment in there? Does it apply at 5 employees? Does it apply at 20 or 50? Paid sick leave, a state FMLA equivalent, state ADA equivalent, mini COBRA laws. Those often apply. So COBRA applies at 20, but in Tennessee it applies for at 5. Those sorts of things. You got to look at your wage and hour. That's minimum wage, overtime, meal and rest breaks. And you got to look at final paycheck timing. Okay. Some states require same day or next day for terminations as opposed to later on, next payroll. And also on those accruals, whether they have to be paid out on the vacation time or sick leave for that matter, but mainly vacation time. If they, you may have a use it or lose it policy. Some states don't allow that. California has over 18 different types of leave. New York paid family leave kicks in at 1 employee. Colorado has FAMLI, which is a paid family leave program as well. If you hire in one of those states without checking, you're out of compliance on day 1. So make sure to go back to 71 and check those out. Then, we're not quite done. We're getting close. You have to check for local obligations. Some cities and counties have their own employment laws that layer on top of state law. Just like you chose to open a branch, like I said, it's opening a branch in another state. If you chose to open in Philadelphia or New York City or Seattle or San Francisco, you've got additional laws on top of California's, all right, on top of the states. San Francisco has a higher minimum wage, paid sick leave, healthcare security ordinance, and fair chance ordinance that the state doesn't. Seattle has a higher minimum wage, paid sick leave, and secure scheduling laws where you can't change their schedule as often. New York has that paid sick and safe leave. They have salary transparency rules, AI hiring bias issues. Philadelphia has fair scheduling and ban the box. So if your employee is in a major city, you might have city-level obligations on top of everything else. It's not just the 50 states. It's 50 states plus hundreds of local jurisdictions. Okay. Now, once you've laid those out, you got to think about the nexus chain. So one employee doesn't just create those employment obligations. It can create tax obligations. This is beyond the realm of my expertise. We're a people processes HR channel. But you need to talk to your CPA about sales tax and corporate income tax. Okay. The chain reaction is you hire one person and suddenly you owe that state payroll taxes, unemployment, workers' comp, employment law, and then sales tax and corporate income tax. That's a lot. And I'm not familiar deep enough. Every state is different. But the oldest form of nexus is having an employee in there. Okay. Even if you have no office, no inventory, and no customers, the oldest form of nexus is having boots on the ground. Okay. Now, take it all, make a single Excel spreadsheet that lists every state where you have employees, what you're registered in, payroll, unemployment insurance, workers' comp, sales tax, corporate income tax, which employment laws apply, renewal dates and filing deadlines, and updated every time you hire in a new state. This is your compliance map. When a manager says, I want to hire someone in Oregon, you pull up the tracker, see what Oregon requires, and tell them, hey, we're not doing Oregon, okay? Or we're all set up. Here's what you need. So that's a lot, I know, to think about and be worried about. Don't try to fix everything at once. I want to encourage you to look at this from a priority perspective. So if you are in this situation and you've already hired a bunch of remote worker employees, first thing to fix, workers' comp. Biggest fines, biggest penalties, biggest liability. Okay. Then you got to go look at your state income tax withholdings, then your state unemployment, then your state employment laws. That's the order that I would go in, because you've been out of compliance with the laws and leaves for a while, but the penalty isn't racking up. It's a risk. You are incurring an extreme penalty and danger for workers' comp. You're putting taxes in the wrong state. That's your income tax withholding, or you're insuring them for unemployment in the wrong state. That can be a problem too. Then go on to your handbook and those sorts of items. I've put together a new state employee checklist. It's in the description below. It's got the 6-step registration checklist, tax, UI, workers' comp, the whole sequence, a tax withholding decision tree so you know whether to check for reciprocity or not, a state employment law, quick reference, covering kind of the biggest compliance areas by the larger states, and a multi-state compliance tracker template that you can use as your ongoing map. Okay. To download it, you go to the link below. You have to put in your email address. That's the cost of doing business. It's how we build our list. I only bug you once a month. All right. I send you an update letting you know we got a new episode and here's what the new stuff is. But you get access to all of our templates and guides. At this point, 72 of them, all kinds of great stuff to help build and scale your operations on the people side. If your multi-state compliance has gaps, your HR overall almost definitely does too. I would love to do a strategic HR audit for you. It's where we look over about 18 different domains. It takes about an hour and a half. And basically, I'm just going through and looking at what you may have wrong. And then I create a list and priority system to show you how to fix them over the next 12 months. It's going to be completely free for the first 10 companies with more than 10 employees using this episode's link. When you go to the advisor site, in the top left, there's a button labeled audits. There's about 10 audits listed. Click on the strategic one and enter the code EP73AUDIT. That's Echo Papa 73 audit at checkout. When you do that, it's going to go from $1,000 to $4,000, depending on the size of your organization, down to zero. First 10 companies with 10 or more employees in the United States, we will do that for you for free. A couple other notes. Episode 71, we talked about it, covers leave law compliance in detail. That's step 3 of this checklist, and it's one of the things that catches most employers. And episode 69 is on summer hiring. If you have teens working in a different state, you've got child labor compliance on top of everything else in this episode. So I want you to check those out. My name is Rhamy Alejeal. Every growing business hits this wall eventually. The ones that plan for it will save tens of thousands of dollars. The ones that don't find out the hard way, usually from a state auditor. Get the checklist, check your registrations, and talk to your CPA about sales tax and income tax nexus. Don't HR alone, and I want you to go out there, have a great day, and get your work done. Thanks for tuning in. I look forward to seeing you soon.